Welcome to Jim's Notes. I'm Jim Farish, editor and founder of Jim's Notes. As we do periodically, we record updates when I think there's something that we want to look at visually. And I think the market the last couple of weeks has really put itself in a position to raise a lot of questions as it relates to where we go from here. A lot of speculation about what's going on. So I want to kind of go through some of the sectors and look at charts. So as that may be, let's look at see what's happening. If you're not a subscriber, you want to take advantage of that and join. You can go certainly through the site and look at that. $200 a year for all the research notes that we publish pretty much every day. So as we look at the market right now, I think this chart really kind of puts in perspective what we think relative to the technical aspects of the market. So let's just put a line here. You can see that we've got a downtrend line right here on the two tops of the S&P. Another issue point is that we get right in here at the 2075 level. We've got another top. So you got a high, lower high. Test the lows here at around the 2022 level off of the first high. We test the lows at a lower low of 2012 on the next one. And today, on Friday, to close out December the 18th, we're at 2010. So we're establishing a series of lower highs and lower lows, which is essentially a downtrend, which we all know. But what is the issue? I think when you break it down, the biggest issue for the market right now is uncertainty, lack of clarity, no better way to say it. We can ramble about all the things that are out there causing the worry, but in reality, it's the fact that we can't see forward. In other words, yes, price destruction in oil is a concern to the market. It is a worry to investors, but more importantly, it's the fact that we don't show growth in earnings, growth in revenue. We've been lagging for 4 consecutive quarters. All of those are key issues fundamentally that the underlying erosion of the market is being created by. It's the day-to-day events and some of these elongated events, such as crude oil, that continue to rattle investors. But let's face it, outside of the energy sector, oil prices going down really is more of a plus for the economy than a negative. But now, because energy has been the leading job getter over the last several years, energy has been one of the key stability factors for putting money into the economy. And now that we're destroying that, taking jobs away, it just creates one more uncertainty factor for the market. And as a result of that, we're seeing the market continue to slowly erode. That brings up the question, do you short the market from a longer-term outlook? I would have to say if we take out these levels right in here around the 2000 level, the answer to that to me would be more of a yes than a no. And so from my perspective, I think there's things that we all have to consider here and take into account as we move forward. So we'll continue to look at that, effectively from the standpoint of what do we do on taking on short positions. I think the best way to look at short positions is to first of all look at the trade. If I were looking for a downside trade in the S&P, we did post that this morning with SPXS, which is, you can see the 3-time short. The entry off of this trade was at 1720, was the ideal entry coming in today, so we get a gap higher, but we did take the trade at 1730 on the open. And if things had not worked out on that short trade, we would have exited that trade around the 1680, 1675 level had it been a short blip on the upside and a reversal. But the way I look at it right now is that short trade's in. If this is an elongated trade, you can add to the position. If you move above certain levels, the next level that we would look at is right in here around the 1790-ish level. If that holds, obviously, then we would look at that going on Monday, 1826. The 200-day moving average is right here at 1843. All of those would be positions to look at adding to your short position. If you don't want the leverage, then you just look at SH, which is the unleveraged version of shorting the S&P, and you create the same entry levels relative to that short, but you can ladder into the short positions if this is going to become elongated or longer term. And going back to the chart of the S&P 500, I think you have to come in here and say, all right, if we took out this level right here at the 2020, 22 level, the next level to take out would have been right in here around the 2013 level, which we have done. And then the next level is right there around the 1990 level. And then that would take you all the way back down to the lows from August and September. So each of those are in play. So you can see this is a gradual event for the market to create or build a short position if we are truly going to sell off more as we go along. And I'm not here to say we are, and I'm not here to say we are not. I'm not a speculator. I'm not a pontificator. I do see the market setting up for a trade. If this develops into something more than that, it will tell you that through the charts as it goes along. That prophecy will fulfill itself, but you're already in the position at a level you're comfortable with, and you can always add to these positions as you go along. It's just called laddering in or out of a position. But don't, back yourself or paint yourself into a corner believing the only thing you can do is buy all in or all out, because that's just not true. QQQ, which is the NASDAQ 100, you can see here I'd be looking at 109. On the downside, SQQQ is the leverage short side of that. And the reason why I look at the leverages on the short side is because the short side tends to accelerate time-wise. It happens faster, so you want to take advantage of what does happen or does occur, and allows you to ladder out of the position, take profit sooner, and dampen the risk of actual trade as you go along. Even though people think that leverage trades add risk, I think that they put you in a position of sweeping money off of the table faster, and then also from the standpoint that you can take advantage of the actual short trade for what it is. So if you get a 3 to 5% downside, you're going to get a 9 to 15% return on the leverage versus the risk of the short trade. To me, is higher than the risk of a long trade, because short trades happen faster, so you have to be methodical about your approach relative to that. But I do think the market is setting up, and I did talk about that in the weekend notes as well, so you can view those at your leisure. The other side of this, of things that are of interest to me, is VXX, which is the volatility index. You can see we did get above 2060, which would be the entry point there. 2092 is the next entry, and then 2423, and we would watch that as it unfolds. So we added some VXX today at 2060. We'd look at 2192, and we look at it as it also goes higher. As far as crude oil, it would be nice to want to say I want to short it. I looked at a possible short trade at around 140 on SEO today, which is Friday. I'm not real. I have to, in some ways, the logical side of me says trade it and don't worry about it. On the other side, I think you have to admit that there is some exacerbation relative to the price of crude. Just really wasn't willing to take the trade. But that being said, you also have a setup in the short side of buying into what is going on the chart. And you can see this is a flag or a pennant pattern on ERY, and we even posted this morning that we would be willing to trade it above 3060. We got that trade, and you can see that it actually has moved higher from there. So it's starting to break out. So you may not like what ultimately is the problem causer, which here is crude, but the stocks give you a little more diversification, a little less risk on the table, because I don't think the stocks have sold out relative to the price of crude. So we'll see how that trade unfolds. But now I can move my stop to break even. I could even take half off the table, but that's just money management techniques relative to the trades themselves. Tech is the other thing that we see breaking down. You can see on XLK, we did break below the 200-day moving average. We did take out this November low. Tech is starting to break down. You can see that trading range. We break from it. I would look for the follow-through into that next week. TECS, which is the 3 times leverage short trade on the technology, is what I would look at. And then the downside of this would be the SOX. I'd be looking for the SOX to break below that 88.63 level. SOXS is the short trade for the SOX, and you can see that would put you above this previous resistance. And then you could see another 2 or 3 entry points if that starts to unfold, but you can ladder into the short trade on the semiconductors. Russia, this is being impacted obviously by the oil trade, 1, and then 2 is the emerging market trade, but oil trade more than not. You can see the consolidation in here, kind of a pennant pattern off of that move up. I still think if oil stays down, energy continues to struggle, Russia will struggle along with it, so that I think they trade in unison. The upside to China, you can see the downtrend is still very much in place here. That's something that I would look at going forward. If we can break above that downtrend line, I'd look at the long trade. If it doesn't find its way above it, then this is going to only reverse and move that down to the downside. And again, each of these are on the notes that are posted that you can go and look at. If you're not a member, you can send an email to don@jimsnotes.com, JIMSNOTES.com, and he'll give you a free trial to actually read those notes this weekend if you'd like to do that as well. Financials is the other that I continue to see a little bit of weakness in the banks. You can see the short side of that trade has moved up. If we look at XLF, you can see that it's coming back down. Took out support there at the 2350 level. I thought that was a huge negative there today at 2330. So look at the short side there, FAZ. KBE, which are the banks, you can see the break back below the 3387 support level. I just think that a lot of things are negative. You can see regional banks breaking down. If you look at the insurance, or the brokers, you can see that they've moved back down to their support levels. You're getting a lot of capitulation here on the downside, which makes me believe that as we go into the balance end of the year, we could see it. You can have low volume trading as you go into the holiday periods. Those are all things that work against this market based on the momentum we see in place right now. So those are some of the biggest things that I see on tap. And then I want to go back and look at the sector rotation component of this relative to pivot points. And we haven't talked about this in quite a while, but I want to go back and you can see that we have a pivot point here on the downside. And I'm going to use this last pivot point, right? We can use any of these, right in here, here, or here. Those are the triple tops that are in play, but let's use this one, scroll back and look at what's going on relative to the S&P. All of the colored lines are the 10 sectors of the S&P relative to the bold white line, which is the S&P index. You can see energy on the bottom is the leader to the downside. You also can see basic materials there on the downside that are starting to move lower. And then the blue line, which is industrials, have actually broken down pretty aggressively. The green line is financials, and then consumer services, and then you've got technology. But you got 1, 2, 3, 4, 5, 6, 7 of these sectors now trade below, off of that pivot point, below the S&P, only 3 above it, and they're starting to accelerate back towards it, meaning the market is breaking down. If you get all 10 below that off of the pivot point, you basically the market is selling off in a larger degree, something that would concern me as well going forward. So those are all issues that we see on the horizon of things that really are not panning out very well. This is just our ETF scan looking for what's leading the market. And I want to pull this back across here. Let's see if I can get this out of the way. And if we look at the scan, and this first part right here, this column right here is Friday's close. So you can see that the volatility index was one of the leaders. Russia, financials on the short side, tech on the short side, energy on the short side, and then you got SKF, which is another short financial, MLPL, which we are short right now, which is short the master limited partnerships, even though they bounced a little bit on the day. We've been short this, and we'll look at this. You kind of got a downtrend with some consolidation. If that holds that 14.95 level of support, then we'd exit the short. But you can see just by flipping through this that you've got some interesting setups on the short side. Then the other part of this would be go to the 5-day returns, and you can see natural gas, which has been just an ugly train wreck to go with oil. You can see TAN, which is alternative energy solar, and that came up to resistance right here around the 3260, retraced a little bit on the day, but I like what's happening there. The gold miners have been reacting to the price of gold, even though gold rally on Friday. But you get the point, is that you can start to see on a progressive basis what's starting to happen. If you look at the 10-day trailing period, you can see the oils, the Russia, the SOX, the small cap shorts, retail, basic materials. I mean, you can see the leadership on the downside. And so we use these scans to kind of look at what's happening right now, which is what's setting up as we go forward. So let me summarize as we go into next week, the Christmas holiday, and then we got the New Year's holiday the following week. So I look for lower volume trading going into the balance of the year. I still think we're on the negative side of momentum, which is not helping. I would be looking at short trades only. If they pan into longer term positions, that's great. But I still think cash is king. I don't think you have to be fully engaged in the market at all times. I think that's a misnomer that a lot of investors and traders take with them. Take it for what it is. This market has a lot of nerves attached to it. It's not looking overly optimistic at this stage, and I think you still have to kind of back away, take a deep breath, and let all of this unfold. I don't think that at this point we can say the market is going down faster. I think the market is going down at this point. How it continues from here is really a matter of the dominoes lining up and each of those worries causing enough anxiety or angst in the marketplace itself for it to gain traction or acceleration and momentum on the downside. We don't see that at this point. Today was ugly, being Friday. Thursday was ugly. But you have to let all of these things really confirm. I mean, everybody may go home over the weekend, come back on Monday in a positive mood and start buying stocks. You have to look at whether or not we're oversold at this point. All of those are key issues, really, as we take this one step at a time. So don't assume anything. Don't make bad decisions. Allow the market to come to you versus chasing the market, and take it one day at a time. So with that, have a great weekend, and we'll see you next week.